Right, so picking up where we left off, we will continue with the exercise that we started earlier. The two friends who now own a lemonade stand are ready to start working and making some money. Here is how their business went throughout the summer. In the first 2 weeks of operations, they used raw materials for $400 and registered revenues of $1,200. Besides paying for raw materials, they received utility bills for $150 and managed to save some money by employing their own work, not having to pay any employees. Let's register these transactions. For the sake of simplicity, we will make single entries for the usage of raw materials and for the sales that the firm made. As you can see on the right part of the sheet, we have a new daybook that will contain income statement items. Balance sheet items show us what the firm owns and owes, while the income statement contains components like income and expenses that give a taste of the company's profits. So, let's get to work. The first transaction that we need to show is how raw materials, in our case lemons and other products, were used in order to produce lemonade. Therefore, we need to register the decrease of raw materials and show where they went. We took the raw materials that we bought earlier and produced lemonade. As we said in our previous videos, there is a specific P&L item that contains the costs of the products that we sold. This item is called cost of goods sold. We had $500 in our raw materials account, right? Okay. And now raw materials that cost $400 are used in order to produce the goods that the firm sells. So, we need to show that raw materials were used in order to produce final products. How do we do that? Quite intuitively, we'll have the following entries. The date of the two entries is the 26th of June. Okay. The first account is raw materials, which is a balance sheet account, while the second account is cost of goods sold, which is an income statement item. So, raw materials decreased because we took them out of our inventory and used them in order to produce goods. When an asset decreases, we need to credit its account, right? Okay. Then these raw materials enter into the cost of the goods that we sold. This is an expense, and we already learned that when an expense increases, we need to debit it. Do you remember the logic? Liabilities and equity stand on the right side of a balance sheet, correct? When a liability or equity is increased, we credit such an account because credit means right. Net income is part of equity, right? Okay. So revenues, which is an item that increases net income, will behave like equity, while costs, which go in the opposite direction, will behave in the opposite way. Remember this logic, and things will be really easy for you. This is why raw materials will be credited for $400, while cost of goods sold will be debited for the same amount. Let's add these entries to our T accounts. We can copy a small T account from the balance sheet and paste it 2 times. I'll change the titles of the new T accounts to Revenues and Cost of Goods Sold. Okay, let's type the 2 entries here as well. We are crediting raw materials in the balance sheet because raw materials are decreasing. And then we are debiting the cost of goods sold account. That's perfect. Next, we need to account for the firm's revenues. The two friends were able to sell lemonade for $1,200. Clients pay for the lemonade directly with cash, and this is why we will have the following entries. On the 26th of June, the firm was able to increase its cash by $1,200. Cash is an asset. Therefore, we have to debit the cash account. The money was received because the firm generated revenues. We need to increase the revenues account as well. An increase of revenues means that the account needs to be credited. Okay, great. The next thing I will do is transfer these entries into the respective T accounts. We have a debit of $1,200 for cash and a credit of $1,200 for revenues. On the 26th of June, the two friends received utility bills worth $150 that were related to their electricity and water consumption. They paid the bills on the same day. Let's register the transaction in our daybook. Utility expenses are something that is strictly related to the financial period under consideration and should not be capitalized on the balance sheet. In general, one part of a firm's utility expenses should be considered within cost of goods sold. This is the part which is directly attributable to the production process. In our case, we cannot make a distinction, and that is why we will leave a separate expense account named Utility Expenses. Having said that, let's make the daybook entries. We are paying the bills with cash, right? This means that cash will decrease. Cash is an asset, and it increases to the left side and decreases to the right side. Right means credit, and that's why we can say that we will credit cash. We will credit it for $150. Then, in order to respect the double entry principle, we have to include a counterpart entry. As I said, we will have a P&L account named Utility Expenses. It is a cost for the firm. When costs increase, we debit the account. Hence, I will debit the Utility Expenses account by $150. Perfect. Let's do the same thing on the next sheet. I'll need to create a new T account. Utility Expenses. As we said before, the cash account will be credited by $150, while the utility expenses account needs to be debited by $150. Very well. In our next video, we will complete the list of transactions for this exercise, which will allow us to build a balance sheet and an income statement. Stay tuned.